They are panicking. Emergency weekend conference exposed. $80 silver. Behind closed doors, on a weekend when markets were silent, the world's most powerful financial architects gathered in absolute secrecy. No cameras, no official statements, just emergency protocols. Within 72 hours, silver crossed a threshold they said was impossible, $80 per ounce. But this number isn't about silver at all. It's a code, a distress signal from the very system designed to never fail. What were they told in that room? What do they know that you don't? And why are institutional hands moving faster than their official words? The answer will change everything you thought you understood about the next 12 months. Welcome to Financial Inspection. If you found your way here, you're not looking for entertainment. You're looking for truth in a world drowning in narratives. Now, before we proceed with what may be the most critical economic briefing you'll hear this year, I need to ask you something important. You know how you check your insurance policy every year? How you review your legal documents? How you stay informed about matters that actually affect your livelihood? This channel operates on that same principle. We inspect the financial architecture that holds your business, your savings, and your future. So do yourself a favor, the same way you'd keep your accountant's number saved. Hit that subscribe button. Not for me, but because what's coming requires you to stay informed, not surprised. And one more thing. I'm curious, where are you watching this from? Are you in New York, London, Dubai, Mumbai, Singapore? Drop your location in the comments. Because what's unfolding right now isn't happening in isolation. It's global. And knowing where you're positioned geographically might matter more than you think in the months ahead. Now, let's begin the inspection. On the second weekend of December 2024, something unprecedented happened in the global financial system. While ordinary people went about their lives, while families gathered for dinners and entrepreneurs planned their next business quarter, a different kind of gathering was taking place. In a secure conference facility, far from public view, the architects of the world's monetary system convened in absolute urgency. These were not scheduled meetings. These were not routine consultations. This was panic, dressed in expensive suits. The participants included central bank governors, treasury secretaries from major economies, and representatives from institutions that most people have never heard of, but that control trillions in assets. They arrived quietly. No press releases announced their presence. No official cameras documented their arrival. The very secrecy of the gathering told a story that their words never would. In the history of global finance, weekend emergency meetings occupy a special category of dread. They represent moments when the system itself wobbles, when the carefully constructed stability reveals its fragility, when those who manage the machinery realize they may be losing control. The last time such urgency gripped the financial elite was September 2008. That weekend, Lehman Brothers collapsed, and the world watched as the impossible became real. Before that, it was 1998, when long-term capital management nearly triggered a cascade that could have frozen global markets. Each time the pattern was identical. Official calm in public, absolute scramble in private. This December weekend followed that same blueprint. But this time there was a difference. This time, the warning signal came from an unexpected source. Silver, not stocks, not bonds, not even gold. Silver had begun moving in ways that suggested something fundamental was breaking in the monetary architecture. By the time these officials gathered, silver had already breached $75 per ounce, climbing toward a psychological and technical barrier that financial models had dismissed as impossible in the current environment. $80 per ounce. To the average observer, this might seem like just another commodity price fluctuation. But to those who understand monetary history, $80 silver is not a market event. It is a distress flare. Silver has served as money for over 4,000 years. Unlike paper currencies that come and go with empires and governments, silver has maintained its role as a store of value across civilizations. When silver begins to surge against all major fiat currencies simultaneously, it is sending a message that transcends normal market dynamics. It is saying that confidence in paper itself is eroding. The officials in that conference room understood this language perfectly. They had spent their careers managing currencies, manipulating interest rates, and controlling the flow of money through the global economy. They knew that silver's movement was not happening in isolation. Behind the price action lay a deeper reality. Foreign central banks were quietly reducing their holdings of U.S. Treasury securities. Repo markets, the plumbing of the financial system, were showing stress indicators reminiscent of early 2008. Credit default swaps on sovereign debt were widening, suggesting that large institutions were hedging against government defaults. And perhaps most telling, the gap between paper silver prices on exchanges and physical silver available for delivery was expanding dramatically. This gap revealed something critical. The derivatives market, where silver is traded in massive quantities on paper, was becoming disconnected from the physical reality of actual metal that could be held in hand. When paper promises diverge from physical delivery capacity, a reckoning becomes inevitable. The officials knew this. They also knew something else. The traditional tools they had relied on for decades were no longer working as designed. Interest rates could not be raised meaningfully without triggering a debt crisis across governments already drowning in obligations. Money printing, the favored solution of the past 15 years, had created inflation that was eroding public trust and political stability. Currency interventions were losing effectiveness as more nations moved toward bilateral trade agreements that bypassed the dollar entirely. The Emergency Weekend Conference was not called to solve these problems. It was called to acknowledge them and to coordinate a response that might buy time. But time for what? That question hung in the air of that secure facility as silver continued its relentless climb toward $80. The number itself was becoming a symbol, a line in the sand that, once crossed, would signal to the world that something fundamental had shifted in the monetary order. As the weekend progressed and the officials debated behind closed doors, that line grew closer, and the financial world held its breath. The conference room fell silent when the data appeared on the screen. Numbers that should have been theoretical were now real. Numbers that existed only in worst-case scenarios were now staring back at decision-makers who had spent careers dismissing such outcomes as impossible. This was not a moment of discovery. This was a moment of admission. The people in that room had known for months, perhaps years, that the foundation beneath the global financial system had developed cracks. But knowing privately and acknowledging collectively are two entirely different acts. What forced their hand was not wisdom, it was mathematics. The kind of mathematics that does not negotiate. Let us understand what they were looking at. Across the major economies, government debt had reached levels that history suggests are terminal. The United States carried debt exceeding $36 trillion, with a debt-to-GDP ratio approaching 130%. Japan had long since passed 240%. European nations, bound together in a monetary union without fiscal unity, faced their own compounding crisis as member states struggled under obligations they could never realistically repay. But debt levels alone do not trigger emergency weekend meetings. Debt has been high before. What triggers panic is the cost of servicing that debt, interest expenses. As rates climbed from the near zero levels of the previous decade, governments found themselves in a trap of their own design. The United States was now spending over $1 trillion annually just on interest payments, not building infrastructure, not funding programs, not investing in future productivity, simply paying interest on past borrowing. This created a vicious cycle. Higher interest costs required more borrowing, which increased the debt, which eventually would require even higher interest payments. The mathematical endpoint of this cycle is well documented throughout history: currency crisis. The officials in that room were watching this cycle accelerate faster than their models had predicted. But the truly alarming data came from a different source entirely: the repo market. For those unfamiliar, the repo market is where financial institutions borrow cash overnight using securities as collateral. It is the plumbing of the financial system, invisible to the public, but absolutely critical to daily operations. When repo markets function smoothly, banks can access short-term funding easily and cheaply. When repo markets seize up, the entire financial system can freeze within hours. In September 2019, repo rates suddenly spiked from 2% to 10% overnight. The Federal Reserve had to inject hundreds of billions to prevent a systemic breakdown. Most people never heard about it. But central bankers remembered. Now, in December 2024, repo market indicators were flashing similar warnings. Liquidity was evaporating. Institutions were hoarding cash rather than lending it. The willingness to accept government bonds as quality collateral was diminishing. This was the unspoken crisis. When even the safest assets in the system begin to lose their status as reliable collateral, the entire edifice of modern finance wobbles. And then there was the data from overseas. Foreign central banks, particularly in Asia and the Middle East, had been steady buyers of U.S. Treasury securities for decades. This buying served two purposes. It kept the dollar strong, making American imports cheaper, and it recycled trade surpluses back into dollar-denominated assets. This arrangement was the bedrock of dollar dominance, but the data now showed a dramatic shift. China had reduced its Treasury holdings by over 20% in 18 months. Japan, the largest foreign holder, had quietly begun diversifying into other assets. Saudi Arabia was negotiating oil contracts in currencies other than dollars. The BRICS nations had accelerated their alternative payment system, designed explicitly to bypass Western financial infrastructure. Each data point alone might be explained away. Together, they formed an unmistakable pattern. The world was slowly, carefully, deliberately moving away from dollar dependence. This was de-dollarization in real time, and it was happening faster than official projections had anticipated. The officials understood the implications immediately. If foreign demand for dollars and dollar-denominated debt declined, the United States would face a choice: either cut spending dramatically to match actual tax revenue, or print money to cover the gap. The first option was politically impossible. The second option was economically suicidal. Printing money to fund government operations when confidence was already eroding would accelerate the very crisis they were trying to prevent. This was the trap, and silver was exposing it, because while officials debated and projected and coordinated, large institutions were acting. Hedge funds were taking massive long positions in physical precious metals. Family offices representing generational wealth were allocating percentages to hard assets that would have seemed absurd just 2 years prior. Sovereign wealth funds were quietly accumulating gold and silver at rates not seen in decades. These movements did not appear in official statements. They appeared in market data, for those who knew where to look. The institutions moving fastest were those with the deepest access to information. They were not waiting for public announcements. They were positioning ahead of recognition, and that positioning was driving silver toward $80. The emergency conference was not convened to stop this. It was convened to manage the narrative once the inevitable happened. Because $80 silver was not the crisis. It was the announcement that the crisis had already arrived. The officials knew they had perhaps 6 months, maybe 12, before the gap between their official statements and market reality became too wide to manage. The weekend meeting was about buying time, but time, like mathematics, does not negotiate, and silver was keeping perfect count. There are numbers that exist as mere data points, and then there are numbers that function as thresholds. $80 per ounce of silver is a threshold. Not because economists decided it should be, but because history, mathematics, and human psychology converged at this precise point to create something far more significant than a price. They created a revelation. To understand why this specific number carries such weight, one must step back from the present moment and examine what silver actually represents in the architecture of monetary systems. Silver is unusual. It exists in 2 worlds simultaneously. In one world, it is an industrial metal, critical to solar panels, electronics, medical equipment, and the infrastructure of modern electrification. In the other world, it is money, perhaps the oldest form of money still recognized across every culture on Earth. This dual nature makes silver a unique diagnostic tool. When silver begins to surge, the question becomes, which world is driving the movement? If industrial demand alone were responsible, the price would rise gradually, tracking supply constraints and manufacturing growth. But when silver moves violently upward despite adequate industrial supply chains, something else is happening. The monetary world is awakening. And that awakening is what terrified the officials in that December conference room, because monetary demand for silver appears only under specific conditions. It appears when people lose faith in paper. The path to $80 reveals this pattern clearly. In early 2020, silver traded around $15 per ounce. By 2021, it had reached $28 as investors began questioning the sustainability of unlimited money printing in response to global lockdowns. Then it retreated, falling back to $18 as central banks promised to normalize policy and reduce their balance sheets. Those promises proved empty. Money printing continued under different names. Quantitative easing became yield curve control, became emergency liquidity facilities. The terminology changed. The underlying reality did not. And silver remembered. By late 2023, it had climbed back above $25. By mid-2024, it crossed $35. And then the acceleration began. $45 in September, $60 in October, $75 in early December. Each surge brought predictions that the rally would exhaust itself. Each prediction proved premature, because the driver was not speculation, it was recognition. The recognition that the gap between paper claims on silver and actual physical silver available for delivery had grown to absurd proportions. The COMEX, the primary exchange for silver trading in the United States, reported registered inventory of roughly 30 million ounces available for delivery. Meanwhile, open interest in silver futures contracts represented claims on over 900 million ounces. This meant that paper claims exceeded physical supply by a ratio of 30 to 1. In a functioning market, such discrepancies cannot persist. Eventually, someone demands delivery, and when delivery cannot be met, the paper price becomes irrelevant. Only the physical price matters. This was already happening in smaller markets. Coin dealers reported premiums of $8 to $12 per ounce over spot price for physical silver. Delivery times stretched from days to weeks to months. Wealthy individuals were buying entire monster boxes, 500 ounces at a time, and waiting 6 weeks for delivery. The squeeze was not theoretical. It was measurable, and institutions watching these developments understood exactly what it meant. It meant that $80 silver was not a ceiling. It was a floor for what was coming next, but the price itself was only part of the story. The more significant element was the ratio. Throughout history, the gold to silver ratio has fluctuated between 15 to 1 and 100 to 1. For most of human monetary history, it hovered between 12 to 1 and 20 to 1. In recent decades, it had stretched to absurd levels, reaching 90 to 1 and even 120 to 1 during moments of extreme silver suppression. But as silver approached $80 with gold trading near $2,800 per ounce, the ratio compressed to 35 to 1. This compression was significant because it suggested that silver was not merely rising, it was catching up to a monetary role that decades of financialization had obscured but not eliminated. The officials in that weekend conference understood this history. They also understood what happened when monetary metals decouple from official control. In 1980, the Hunt brothers attempted to corner the silver market, driving prices to $50 per ounce, equivalent to over $150 in today's purchasing power. The government intervened dramatically, changing trading rules mid-crisis to force liquidation. The intervention worked, temporarily, but it also revealed something critical. It revealed that officials feared silver's price discovery more than they feared market manipulation, because true price discovery in silver would expose the debasement of fiat currencies. Now, 45 years later, the circumstances were different, but the fear was identical. Except this time, there was no single actor to target. The buying was distributed across thousands of institutions, millions of individuals, and dozens of sovereign entities. There was no corner to break. There was only mathematics asserting itself against decades of paper manipulation. And mathematics was winning. As silver pressed against $80, another factor amplified the urgency: electrification. The global push toward electric vehicles, solar energy, and advanced electronics had created industrial demand that could not be ignored or postponed. Every electric vehicle required roughly 1 kilogram of silver. Every solar panel installation required substantial amounts. Every 5G network expansion consumed silver in quantities that previous technology generations did not. This meant that, unlike previous monetary surges in silver, this one had a physical demand floor beneath it. Even if monetary demand paused, industrial consumption would support elevated prices. The combination was unprecedented. Monetary demand driving prices upward while industrial demand prevented meaningful corrections downward. This created a ratchet effect. Each move higher became the new baseline, and $80 was about to become the next baseline. The officials knew that once this threshold was crossed, a psychological barrier would shatter. The barrier that said precious metals were relics, that paper currencies were permanent, that central banks had everything under control. $80 silver would whisper a different truth. That control was an illusion, that paper was temporary, that 4,000 years of monetary history could not be overwritten by 80 years of central banking experimentation. The conference was not about stopping $80 silver. It was about preparing for what $80 silver would unleash, because the number itself would become a signal to every entrepreneur, every business owner, every family protecting wealth across generations. The signal was simple: move to safety, while safety can still be reached. The conference ended as quietly as it began. No dramatic announcements, no policy revelations, just carefully worded statements about monitoring conditions and maintaining stability. The kind of language that says everything by saying nothing. But while official words remained calm, institutional actions told a different story. In the 72 hours following that weekend meeting, something shifted in global markets. Not loudly, not obviously, but for those trained to read the signals, the shift was unmistakable. Major banks began adjusting their commodity exposure. Wealth management divisions sent revised allocation models to high net worth clients. Sovereign wealth funds accelerated diversification programs that had been moving slowly for months. The pattern was clear. Those with the earliest access to information were positioning ahead of public recognition. This is how institutional knowledge works. It does not wait for headlines. It does not wait for official confirmation. It moves in the space between private acknowledgement and public announcement. And that space, historically, offers the greatest advantage to those who recognize it. For the business community, this presents both challenge and opportunity. The challenge is obvious. Operating an enterprise during monetary transition requires navigating uncertainty that spreadsheets and financial models struggle to capture. Contracts signed today may be settled in currencies worth significantly less tomorrow. Supplier relationships built on stable pricing assumptions may fracture as input costs become unpredictable. Cash reserves held in traditional banking instruments may lose purchasing power faster than interest rates can compensate. These are not theoretical concerns. They are practical realities that businesses in Argentina, Turkey, Lebanon, and Venezuela have faced in recent years. The difference now is scale. What happened in those economies was isolated, contained within their borders. What the emergency conference signals is something broader, a recognition that the largest economies, the reserve currency itself, face structural challenges that monetary policy alone cannot resolve. But within this challenge lies asymmetric opportunity. Because while large institutions move slowly, bound by compliance frameworks and bureaucratic inertia, smaller enterprises can adapt with speed. This is the entrepreneur's advantage. the ability to recognize change early and position accordingly while larger competitors remain committed to strategies designed for a world that is already disappearing. So what does strategic positioning look like in practical terms? First, it requires understanding what is actually happening beneath the surface. Silver crossing $80 is not an investment thesis. It is an indicator that the relationship between paper currency and tangible assets is being repriced globally. This repricing does not happen uniformly or predictably. It happens in waves, with periods of apparent stability followed by sudden adjustments. The officials who met that December weekend are attempting to manage these waves to smooth the transition and prevent panic. But management is not prevention. The underlying mathematics has not changed. Debt levels that cannot be repaid through taxation will eventually be resolved through currency debasement. This is not a prediction. This is historical pattern recognition. For business owners, the implication is straightforward. Holding wealth exclusively in currency-denominated instruments carries risk that previous generations did not face. This does not mean abandoning banking systems or operating outside conventional finance. It means diversifying across asset categories that respond differently to monetary stress. Tangible assets with intrinsic utility. Productive businesses that generate cash flow regardless of currency denomination. Real estate in locations with strong property rights and stable governance. Relationships with suppliers across multiple jurisdictions to reduce single currency exposure. These are not speculative positions. They are structural adaptations to a changing monetary environment. Second, positioning requires monitoring the right indicators. Official statements will lag reality by months or years, but market indicators provide real-time feedback. The gold-silver ratio compression signals monetary stress faster than any government report. Treasury auction results reveal foreign demand for dollar-denominated debt. Repo market rates show institutional confidence in the financial system's plumbing. Credit default swap spreads indicate how large institutions are actually pricing sovereign risk, regardless of credit rating agency pronouncements. Currency movements in emerging markets often precede similar patterns in developed economies by 6 to 12 months. These indicators are publicly available. They simply require attention and interpretation. Third, strategic positioning means accepting uncomfortable truths about timing. The gap between recognizing systemic instability and experiencing its full impact can span years. Japan's debt crisis has been imminent for 2 decades. The dollar's reserve currency status has been ending for 15 years. Yet both continue. Not because the analysis was wrong, but because systems have more inertia than models predict. This creates a psychological trap. Those who position too early appear foolish as years pass without crisis. Those who wait for obvious confirmation position too late to benefit from asymmetric opportunities. The solution is not perfect timing. The solution is graduated positioning that protects against downside while maintaining flexibility for operations. This means avoiding all or nothing strategies. It means building resilience into business operations incrementally rather than waiting for a single moment of clarity that may never arrive. Fourth, there's the question of communication. Business leaders face a choice in how they discuss these dynamics with partners, employees, and stakeholders. Speaking too directly about monetary instability can create unnecessary alarm. Speaking not at all leaves organizations unprepared. The effective approach involves framing preparation as prudent diversification rather than crisis response. Just as businesses maintain insurance, diversify suppliers, and build cash reserves as standard practice, expanding into tangible assets and cross-jurisdictional relationships becomes another form of operational resilience. Finally, there's the recognition that what appears as crisis to some represents transition to others. The officials in that December conference room see their world ending. The world where central banks controlled outcomes through policy statements and interest rate adjustments. The world where the dollar's dominance was assumed rather than earned. The world where paper claims were treated as equivalent to physical assets. That world is not ending overnight, but it is ending. And in its place, something older is returning. The recognition that real value requires real assets. That promises to pay are not the same as payment. That 4,000 years of monetary history contain lessons that 80 years of experimentation cannot erase. $80 silver is not the cause of this transition. It is the measurement of this transition. And for those watching carefully, it provides something invaluable. Time. Time to position, time to adapt. Time to build resilience before the gap between official narratives and market reality becomes too wide for anyone to ignore. The emergency weekend conference revealed that officials know the clock is running. The question for the business community is simple. Are you listening to what they say, or are you watching what they do? Because in the space between those two things lies the truth. And in that truth lies the strategic advantage that separates those who navigate transitions successfully from those who are surprised by them. Silver reached $81 the following Tuesday. The officials released a statement expressing confidence in market stability. And institutional money continued moving quietly toward safety. The inspection is complete. The warning is clear. What happens next is a choice.